Welcome everyone to our 6-monthly financial stability review. I have with me Jeff Baskand, Deputy Governor on my left, and Bernard Hodgetts, Head of Macro Financial Stability on my right. Our view is that the New Zealand financial system remains sound and risks to the system have reduced over the past 6 months. Internationally, growth momentum has continued and near-term risks have reduced. However, the New Zealand system remains exposed to elevated asset prices and high debt levels in a number of countries. Domestically, LVR policies have been in place since 2013 to address risks arising from rapid house price inflation and increasing household debt. These policies have helped to improve banking system resilience by substantially reducing the share of high LVR loans. Further, over the past 6 months, pressures in the housing market have continued to moderate as a result of the tightening of LVRs late last year, a more general firming in bank lending standards, and an increase in mortgage rates earlier this year. Going forward, housing market policies announced by the government are also expected to have a dampening effect on the housing market. So, in light of these developments, the Reserve Bank is undertaking a modest easing of the LVR restrictions, and from 1st of January, the LVR policy will require that no more than 15% of new mortgage lending to owner-occupiers can be at an LVR of more than 80%, and this is up from 10% currently, and no more than 5% of new mortgage lending to residential property investors can be at LVRs of more than 65%, which is up from 60% currently. The bank will monitor the impact of these changes and will only make further adjustments if financial stability risks remain contained. A cautious approach will reduce the risk of resurgence in the housing market or a deterioration in lending standards. Jeff.
Looking more broadly at the financial system, it appears sound when viewed through a number of lenses. The banking system has adequate capital with a satisfactory buffer over the minimum regulatory requirements, and it appears to be operating efficiently. The recovery in dairy commodity prices since mid-2016 has supported farm profitability. Recent stress tests suggest that banks are well positioned to withstand a severe economic downturn and operational risk events. Turning to regulatory developments, we've released 2 consultation papers on the review of bank capital requirements, and a third paper on the measurement and aggregation of bank risk will be released shortly. The aim of the capital review is to ensure a very high level of confidence in the solvency of the banking system while minimising complexity and compliance costs. The bank has also completed a review of the bank directors' attestation regime. We expect to elaborate on its findings and our response next year. We're making good progress in implementing a new dashboard approach to quarterly bank disclosures. This is expected to go live in May next year. Thank you.
Okay, so let's open up to questions.
So in easing the LVRs, are you able to give us some indication of how many more owner-occupier mortgages are likely to be approved under the softer measures?
Well, the actual number, clearly there'll be some increase in loans at the higher LVRs. The banks do apply their own buffers, so we're not expecting a significant increase. So the main message here is this is an incremental change. It's an adjustment, giving the banks a little bit more room to, use those high LVR loans as appropriate. We would expect that a relatively greater proportion of first home buyers would benefit from this, given that the existing high LVR lending does tend to be more shifted towards the first home buyers rather than other owner occupiers.
Do you have any, hard figures on that, on what you're expecting the change to be?
Well, to give you some sense of scale, I mean, over the last 12 months, banks made something in the order of about $54 billion worth of new loans to owner-occupiers. So, if you were looking at an extra 5 percentage points of that 54 billion being high LVR, greater than 80%, then that would give you some approximation of potentially how much more they might be doing in that space over this coming year.
Okay, so that's the value, the percentage of value. Do you
Correct.
have any data on the number of applications at all?
Not on hand, no.
Okay, thank you.
In the middle there? Yep.
Is there any concern? I know some of the bank economists have already expressed a little bit of surprise and concern that this could lead to a reinflation of the housing market, that we haven't fully seen the impacts of the uncertainty of the election, for example. How worried are you that it may, in fact, spark things up again?
Well, there's always uncertainty, so we can never be 100% sure with these things, and there's definitely still risks around the housing market, but this is why we're taking an incremental approach here. Also, we're given some confidence by the government policies, which we think are going to reinforce the moderation, things like the Bright Line test, restrictions on foreign buyers, the ring fencing of investor losses, and also the Kiwi Build program. They will be acting to moderate the market. And then, we also feel that bank credit standards, which have been reasonably tight, that's going to continue in terms of, we do surveys of the banks and the levels of their credit standards, and we think they'll still be applying a pretty tough approach going forward.
Given that you're taking this incremental approach, how long do you think it will be before the LVRs are completely removed?
Well, we don't know, so we deliberately have not sort of set out some sort of schedule for their removal, because the removal is conditional on things remaining stable and risks remaining contained. So we will review it from time to time. Our internal, reporting cycle tends to be quarterly, so we tend to have a quarterly review of these things and make further adjustments as appropriate.
So you haven't got a sort of draft schedule that you've set out that then may be moderated or changed, but...
No, we don't. No.
Hi, just another question on what impact you see immediately on the housing market. Thank you.
Well, we wouldn't see much impact. As I say, there may be some incremental change in terms of numbers of higher LVR loans and some investor loans at LVRs of over 60%. But those will be relatively small volumes. And given all these other factors that are at play in the housing market, our expectation is that the market will remain moderate. Now, it never sort of sits still, obviously, and there's a lot of moving parts in the housing market. Auckland has been weaker than the rest of the country, but the rates of price increase in the regions, while higher than Auckland, have been coming down. And, there's always going to be some degree of cyclicality in the housing market. We don't own it or control it, and we've never said that our aim is to eliminate the housing cycle. We're always going to have a housing cycle. But, at the margin, there'll be some relaxation on the higher LVR lending.
Two questions. If you can't tell us when you might relax the rules further, can you tell us what it might take for you to remove the rules? For want of a better word, can you explain what the exit strategy is? And secondly, given that it was only formed about a month ago, can you expand on your confidence that government policy will dampen the housing market, given that we certainly haven't seen any nails driven in Kiwi-built homes?
Well, our criteria were sort of twofold. One is that risk is reduced so that house price inflation is moderated and credit growth is moderated. And the key second element, of course, is that there's not a resurgence of risk once we make this adjustment. So we'll be looking to see whether the overall effect from this policy adjustment and other things that are going on, the market remains moderate and credit growth remains at relatively low rates compared to the growth in nominal incomes. And so these are sort of our criteria, and as long as things remain stable, then we'd make further adjustments in due course. In terms of the government policies, you're right, they're going to take some time to get going, particularly the Kiwi build, and the government said that they're ramping up to 10,000. Their aim is to ramp up to 10,000 over a 3-year period and then continue at the 10,000. Some of those other things, like a bright line test, I would say have an impact before they're necessarily in place. If things are targeted at investors are forward-looking, therefore they have an impact now. So I think those the prospect of bright line and movement and the ring fencing, for example, those sort of factors are going to keep the investor market on the back foot, even though they may not have actually been implemented yet.
And just to evidence that, we have got some data in the report on price expectations, which have come down a long way from what was a general expectation of prices continuing to rise 10-15%, down to expecting prices to remain pretty flat, modest.
What's your current thinking on the use of hybrid type securities as bank capital?
Well, on that topic, we had a consultation, as you know, and we've received submissions, and our next stage will be to sort of come back and give a clearer indication of where we're going on the eligible capital instruments. But as indicated in our consultation document, we don't. We think there are issues around hybrid instruments, and we're not particularly attracted to them, and that they're complex, and we're not sure that they really serve a good purpose in terms of being a strong capital instrument, particularly for supporting going concern capital in a stress situation. So, we'll talk further about this when we, put out our next document. But our sort of, indication of direction is not supportive of the hybrid instruments. And, so we'll be seeing where we go on that, but I don't really want to, predetermine our position, our final position on that at this point.
That's clearly how Westpac's met its new higher capital requirement. And we know that it was using nearly half of its models weren't approved by the Reserve Bank. What about the other three banks that are using internal methods of calculating capital requirements?
In terms of the hybrid instruments, sorry?
No. Well, I've just made the point that Westpac used a hybrid instrument to meet its new capital requirement. But also, my question really is, what about the other three banks in terms of getting their internal models of calculating capital approved? Are they all compliant or not?
Well, I'll ask Jeff to comment, but basically we have been approving models of the four IRB banks, which are the four majors. There's been the issue with Westpac, which Jeff might elaborate on, but the others, are getting their models approved, and we don't have issues with those. We have been checking, and we're confident that there's no repeat of the Westpac issue with the other three banks.
My understanding was that Westpac was the one that discovered that they were using unapproved models. So, are you really confident that that there isn't a similar situation at the other three banks?
Do you want to comment, Jeff?
We raised issues with Westpac well before the point of their own official disclosure statement about these issues. So we had suspicions and raised the matter with them on their own investigation. Then they did find that they were not complying, and led us in conjunction with them to request that independent review of the extent of their issues. So yes, the review substantiated suspicions on our part and some reporting on their part. In terms of the other banks, we don't have cause for suspicion. We are encouraged that some of them are looking at their own compliance levels and are undertaking what should be their approach to substantiate their own due diligence and attestation about their compliance. So that's underway, which is encouraging.
I would add, we thought that was a serious case of non-compliance, and we feel it's been an appropriately strong regulatory response. There was the issue of, this non-compliance sort of went back a number of years, and so there's an obvious question about, how long that took to identify. We did revamp our approach to approving internal models back in 2014, was it? Yeah. Where we required a compendium, an actual, file where all these models are, and we know which ones have approved and which ones aren't. And so that process was toughened up in 2014, and we think that is working better now, but we're going to go back and have a further look at that to make sure that this, any non-compliance is picked up at an earlier point.
Did your most recent MPS forecasts take this easing of the LVR rules into account?
Well, we always think about scenarios. That decision had not been made at that point, but clearly the governing committee was thinking about that as a possibility, and so I would say that scenario, if you like, was considered in the broader context of the MPS, even though it wasn't a given decision.
We're very conscious to have one view of the housing market through that period, and to make sure that we had a similar view of the dynamics when we were doing the OCR rate setting as we did.
What I'm going to is I think that when you imposed the restrictions, you commented at the time that you felt it would have a certain impact on monetary policy. So it was, I forget now, but it was worth a quarter point or a half point of tightening, I think you said at the time. I'm wondering if that's the same in reverse. Do you expect this easing to have any impact on your OCR track?
I would say it's this incremental change would have a negligible effect on the sort of hypothetical OCR track. This is not removing it in total. So that calculation you talked about when they put on was about putting on the whole, moving to the full LVR restriction, where we're just talking about an incremental change here.
Okay. Second question was your move is a little more, you're acting a little sooner than many people imagined you would. Is that in any way to be seen as a response to the government's housing policies? Did you see a risk that those policies could have actually led to a decline in house prices, a sustained decline in house prices, and you're acting to try to offset that in any way?
Not really. We don't see, a collapse of house prices as a particularly high risk. So we're not acting because we're concerned that things are about to fall off the edge. But obviously the government policies give us, reinforce the decision and give us comfort that there are a number of other policies and factors that are going to keep the housing market risks contained.
Just back to the exit strategy, given that you're going to wait and see how this plays out before you might move again, is it fair to assume, as it were, that if the rules are going to be reduced, it'll probably be over a matter of years? And secondly, sort of to Matthew's point, can we just get a clear statement that this is not an attempt to breathe life into the housing market, and this is only about financial stability?
Yeah, that's a correct interpretation. This is not an attempt to bolster the housing market or to move it up. It's really just a follow through on our commitment that these policies, the LVR policy, was a temporary measure, not a permanent measure, in response to some very extreme risk and pressure in the housing market that we have seen over recent years. So we're saying, well, things have come off, things are much more moderate, and so we need to look at gradually removing this instrument.
I'll just add that obviously prime factor we look at is the resilience of the banking sector, and so the state of their lending, and what we've seen is the proportion of high LVR loans has come down significantly. We'd want to ensure that remained relatively stable and didn't expand significantly. So on the first part of your question, Hamish, that there isn't a specified time period, but we'll be monitoring the banking resilience as well as the credit and house price movements over that period of time. And it will take some time to relax them, but we don't have a specific period in mind.
Hi there. I was just wondering what's happening to DTIs. Is that still something you want to add to the toolkit, or has that ship sailed? Thanks.
Well, we still think a DTI or some servicing, debt servicing instrument is appropriate to have in the macro-prudential toolkit. But what we've agreed with the government is to postpone further consideration of DTIs or that type of instrument for the macro-prudential review that Treasury and ourselves will be undertaking over the next year. And, elements of this will also come into the government's review of the Reserve Bank Act, the second phase of that review, the first phase being focused on monetary policy. So, it's we still think it's relevant to have in the toolkit. We certainly don't think it's relevant to be applying now, given that the housing market is moderated substantially. But that consideration of that has been deferred somewhat.
Governor, just on that, you do note that incomes are stretched relative to house prices in there. Are you comfortable with postponing the adoption of those instruments?
Yes, well, I am comfortable with postponing the adoption. As I say, we were never in the position of saying that we wanted to put DTIs or felt they were necessary to apply in the near term. Given that the market has been coming off and risk has been reducing in the bank's balance sheets. But as I said before, the housing market is cyclical, and down the track there'll be another housing cycle, and debt service instruments may well be appropriate at that time.
And just on another note, you note in the report that the smaller banks have really increased their share of some of the riskier lending, some of the development lending, and some of the easing of the LV restrictions seem to be because the Big Four are in reasonable shape to sustain that. I mean, do you get the sense that the small banks will step in to adopt that riskier lending profile, and are you comfortable with the shape of the smaller banks' books?
Well, you're right that the the smaller banks have been increasing their market share and doing more business as the major banks have taken a more cautious approach with their lending. And, we've looked at that, and, we're confident that the small banks, while they're increasing their lending, are not stretching in terms of dropping their lending standards. So it seems like it's still good quality lending, even though their volumes are increasing. But we are continuing to monitor that. Is there anything you'd add to that? Yeah.
What's the likelihood of any higher capital requirements on banks to restrain their lending growth? I note that you said that you were still quite confident that the quality of the lending by the banks will be maintained, but do you see any likelihood that there might be a need for
Capital?
Yeah.
Well, we're undertaking this capital review, which we touched on before about the hybrid instruments, and an important part of the capital review will be the minimum capital ratios. How much do the banks actually have to hold? So we will be reviewing those ratios in the early part of next year. And we've said one of our key principles is that we want a conservative approach relative to international peers, and to be very confident about the solvency of the banks. But this is a fixed policy that is sustained over a number of years, and those ratios are not moved up and down to try and moderate the credit cycle, for example. So they're not a macro-prudential instrument.
So it wasn't a factor at all in your decision around the LVRs?
No. So the capital review needs to be seen as a separate exercise about the long-term safety of the system.
I mean, it's worth pointing out that the credit cycle has eased in recent times. I mean, credit growth has cooled over the last 12 months. You can certainly see that in relation to housing, but also in relation to other sectors as well. So, the imperative to slow credit growth as such isn't really a major concern at this point.
Right. And just one quick question about the internal capital modelling that we were talking about before. Will Kiwibank and the other smaller banks ever be able to use that?
Potentially, yes. But, certain standards have to be met, and they have to demonstrate a capability to be an internal models bank. So, but that's open to any bank. But the system was set up, the Basel International System. If you look around the world internationally, it tends to be the larger banks that adopt that framework, and usually it's the case for the smaller banks here and in other countries that standardise sort of works better for them.
You said that the smaller banks increased lending on riskier type projects has still been high quality lending. Do you think it's appropriate the way that the major banks have tightened their lending criteria?
Well, what I said was that the smaller banks have increased their mortgage lending. I didn't say they were necessarily increasing their lending to risky developments. So just to clarify that. But in terms of development lending, you're right, that has been moderated by the banks. They've been concerned about the riskiness of development projects, and so they're taking a cautious approach, and that's one of the constraints that we've observed on the growth in the supply of residential property, particularly apartments. But that's a commercial assessment that they have to make. They haven't stopped. They're just making sure that they are only funding high quality projects and projects that are managed by developers that they have experience with. So you're right. It has a supply effect, but it's part of the process, and it reflects, underlying real constraints in the construction sector at present.
So by and large, you approve of it?
Well, we're certainly approving of the banks acting in a prudent manner, because we're prudential supervisors, and that's our main job.
Just one more question on the Westpac thing. Why did you choose not to prosecute Westpac's directors for the breaches?
Well, we thought that this, as I said before, this was a strong regulatory response that was appropriate and proportionate to the non-compliance. Other forms of enforcement were available to us, but we thought this was the appropriate and proportionate response. Do you have anything to add to that, Jeff?
I think only to reinforce that as a public censure, we've put the Westpac on notice that if they don't comply within 18 months, so if they don't get their governance processes and models approved, then they do risk losing their accreditation status. So I think those just exemplify what the Governor is saying in terms of being serious action that we've taken against the bank for very serious shortcomings in their processes.
Were you surprised at all at Westpac's response? I mean, you'd hardly call it contrition, and you seem to be saying it's a pretty serious offence.
Well, we feel their response was accepting of the fault on their part, very much so. And so I didn't feel that the response that I've seen, that we've seen directly, has been inappropriate. They haven't been questioning the seriousness of their non-compliance nor the appropriateness of the regulatory response.
The bank just released a report on cryptocurrencies, and in that you mentioned that you were doing some work around the possibility of an official digital currency. Could you give us a little bit more detail on that, and also whether it's possible that the bank might do what Japan has done and recognise digital currencies such as Bitcoin, and also whether it's possible that the bank might bring in its own digital currency that will be an official currency at some point?
Jeff?
It's best described as a very early research exploratory phase of work. Clearly this is a field that's moving rapidly around the world, and there are a number of different approaches. Some countries actually banning the cryptocurrencies, others looking to regulate them or experiment with them. We're studying closely what others are doing, examining whether this is a potential replacement for physical cash at some point in the future or not. It's part of a broader program of work that we're looking at our future currency models, both the distribution of cash as well as potentially electronic alternatives to it. But I couldn't give you anything more in terms of possible implications or conclusions of that. It's some time away.
It's an important area for the future. There's no doubt about that. But at present, the sort of central bank community, it's feeling their way as to, where is this going to converge in the long term. But I think it will make a difference. Yeah.
I wonder if you could just sum up what the signal is you are sending to your average first home buyer out there in the market at the moment. What are you saying to them with today's actions that you're backing them and that you want to see them to get in there?
I think we'd say continue to be cautious that this market has moderated. We expect it to continue to moderate. This gives the banks a little bit more latitude in their lending decisions, but again, it's really only a change at the margin, and we don't expect it to have a significant effect at all.
When are you next expecting to do stress tests around banks' ability to cope, particularly with a fall in house prices in Auckland, for example?
Bernard?
Well, we've just, as we report in the FSR, we've just completed a stress test exercise in the last few months, and that's involved, looking at the implications of a serious fall in house prices and commercial property prices and farm property prices, and we've reported the results in this document. On a normal sort of cycle, we would usually expect to do a sort of major stress test, roughly once every 1 to 2 years. So it is a regular cycle. But the latest results are pretty current.
Could I just ask quickly, why did you act so quickly to, as I said, you sort of surprised many people by saying you're going to ease in a month these restrictions. Why didn't you have a longer lead-in time, maybe signal something that something might be looked at in 6 months from now?
Well, we're starting an incremental approach. I guess there were people calling for us to look at this several months ago, if you recall. So, you know, we've been, ever since the market has been coming off, really since mid last year. And so we've been, you know, considering it as particularly as Auckland was flattening out and indeed going negative, you know, that if we don't look at some change and a move to start removing these in this sort of conditions, then, you know, when are we going to look at them?
Okay, and just, there's already been some criticism that you've reduced the required deposit for investors, but not for owner-occupiers. Why didn't you lower that 20% deposit required for owner-occupiers?
Well, I would say the 80% for owner-occupiers is sort of a norm, a sort of well understood threshold for high LVR. Whereas I would say on the investor front, that 60% is probably, you know, tighter, and that a more normal threshold for investors that the banks may apply if left to their own devices would be somewhat higher than that. Whereas, as I say, with owner-occupiers, I think, you know, the banks would tend to regard above 80% as relatively high LVR. So that's essentially the reason. Okay, well, if there's no more questions, thanks very much for your time, everyone.